Welcome everyone. Today we delve into the fascinating world of growth ETFs, VGT, SCHG, QQQM. To begin, let's unravel the mystery of ETFs. ETFs, or exchange-traded funds, are essentially baskets of securities that trade just like individual stocks on an exchange. They encompass a wide range of assets, including stocks, bonds, commodities, and even real estate through REITs. The beauty of ETFs is their inherent diversification, which can help to mitigate risk while offering exposure to a variety of market sectors or investment strategies. Now, let's narrow down our focus to growth ETFs. As the name suggests, these are ETFs that concentrate on growth stocks. But what is a growth stock, you may ask? Simply put, growth stocks are shares in companies that are expected to grow at an above-average rate compared to other companies in the market. They typically don't pay dividends, as they reinvest profits back into their business to accelerate growth. Growth ETFs, then, offer investors an opportunity to participate in the potential success of these high-growth companies. They are perfect for investors who are willing to take on a bit more risk for the chance of higher returns. They bring together a collection of growth stocks into one easily traded package, providing a convenient way to gain broad exposure to this dynamic segment of the market. The importance of growth ETFs in the financial market cannot be overstated. They offer a unique blend of diversification, potential for high returns, and accessibility. Whether you're a seasoned investor or just dipping your toes into the investment waters, growth ETFs can be a powerful tool in your investment arsenal. So, buckle up as we embark on this enlightening journey through the realm of growth ETFs. In the upcoming segments, we'll be taking a closer look at 3 specific growth ETFs, VGT, SCHG, and QQQM, exploring their unique characteristics, examining their performance, and helping you understand why they might just be the investment opportunity you've been looking for. Hello viewers, if you're enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First stop, we explore the Vanguard Information Technology ETF, popularly known as VGT. Diving right in, VGT is an exchange-traded fund that primarily invests in stocks of companies operating within the tech sector. Its focus is on large, well-established companies, but it also includes a sprinkle of mid- and small-cap companies. The goal of VGT is to closely track the performance of the MSCI US Investable Market Information Technology 25/50ths Index, which represents the performance of the tech sector in the US equity market. Now let's talk about its performance. VGT has consistently shown positive performance over the years. For example, in 2023 it had an annual return of about 20%. Not too shabby, right? And it gets better. Over the past decade, VGT has averaged an annual return of about 15%. That's a fantastic track record that few can match. But what exactly makes VGT a preferred choice for many investors? Well, there are several reasons. Firstly, VGT offers a low-cost way to gain broad exposure to the tech sector. This is ideal for investors looking to diversify their portfolio without having to buy individual stocks. Secondly, VGT has a high degree of liquidity, meaning it can be bought or sold easily. This is crucial for investors who need to quickly adjust their positions. Thirdly, and perhaps most importantly, VGT focuses on the tech sector, which has been one of the fastest-growing sectors over the past decade. This focus on growth has helped VGT deliver impressive returns to investors. Additionally, VGT's portfolio is well diversified across different subsectors of technology, including software, hardware, and IT services. This diversification helps reduce risk and provide stability even in volatile market conditions. However, like all investments, VGT comes with its own set of risks. The most significant of these is the inherent volatility of the tech sector. While the tech sector has been a strong performer in recent years, it can also be prone to sharp downturns. As such, VGT may be more suitable for investors with a higher risk tolerance and a long-term investment horizon. Finally, it's worth noting that VGT's success is tied to the performance of the tech sector as a whole. So, if you believe in the continued growth and innovation in the tech industry, VGT might just be the ETF for you. Clearly, VGT is a force to reckon with in the growth ETF space. Next, we shine the spotlight on another notable growth ETF, the Schwab US Large Cap Growth ETF, or SCHG. This ETF is a remarkable player in the field, known for its unique approach and promising returns. SCHG follows a passive investment strategy designed to track the performance of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. This index is an impressive mix of U.S. large cap companies that exhibit growth characteristics. SCHG, therefore, provides investors with exposure to some of the most dynamic and innovative companies in the American market, such as technology giants, healthcare innovators, and more. Unlike some other ETFs, SCHG has a broader focus, encompassing a diverse range of sectors. It's not just about tech or healthcare, it's about growth, wherever it might be found. This makes SCHG a compelling option for those who want to capture the dynamism of the U.S. economy without being tied to one particular industry. Now let's talk numbers. Over the past decade, SCHG has consistently delivered competitive returns, outpacing many of its peers. For instance, in the 5 years leading up to 2024, SCHG has seen an average annual return of around 12%, demonstrating its potential for steady growth. But past performance, of course, is not a guarantee of future results. So why might investors choose SCHG? One major reason is its cost effectiveness. With an expense ratio of just 0.04%, SCHG is one of the least expensive growth ETFs on the market. This low expense ratio means more of your investment goes towards actual growth, not fees. Additionally, SCHG's broad market exposure provides a level of diversification that can help mitigate risk. While it's true that growth stocks can be more volatile than their value counterparts, the broad exposure offered by SCHG can help to balance this volatility. Moreover, SCHG is well known for its liquidity. With average daily trading volumes in the millions, investors can enter and exit positions with ease, offering flexibility and peace of mind. In conclusion, the Schwab U.S. Large Cap Growth ETF, or SCHG, is a compelling option for investors seeking exposure to large cap growth stocks. With its low costs, broad market exposure, and consistent past performance, it provides a unique opportunity to participate in the growth of the U.S. economy. Just remember, as with any investment, it's important to consider your own financial goals, risk tolerance, and investment horizon before making a decision. Always do your own research, consult with a financial advisor if needed, and make sure the investment aligns with your overall strategy. SCHG offers a compelling case for those seeking growth in their portfolio. But don't just take our word for it. Dive into the data, explore the possibilities, and see if SCHG might be the right fit for your financial future. Now, let's unveil the Invesco NASDAQ 100 ETF, fondly known as QQQM. Dive into the world of growth ETFs, and it won't be long before you cross paths with QQQM. This ETF is a powerhouse in its own right, and today we're going to delve into why it's a contender you should pay attention to. QQQM is unique, and its distinguishing traits set it apart in the crowded ETF market. It's a sibling of the well-known Invesco QQQ Trust, which has been a favorite among investors for over 2 decades. However, unlike its big brother, QQQM offers a lower expense ratio. This means that investors can access the same broad, tech-heavy NASDAQ 100 index, but at a lower cost. And we all know, in the world of investing, every little bit counts. Now let's talk about its track record. Since its inception in October 2020, QQQM has delivered an impressive performance. It's managed to mirror the robust returns of its elder sibling, QQQ. But remember, past performance is not indicative of future results. Yet it's a positive sign that QQQM has been able to successfully replicate the performance of a well-established index. QQQM's portfolio is technology-centric, with a high concentration in some of the largest and most innovative companies in the world. This makes it a compelling choice for investors seeking exposure to the tech sector and the growth opportunities it presents. However, it's crucial to note that this heavy tech tilt could also bring additional volatility, especially in turbulent market conditions. Another distinguishing trait of QQQM is its liquidity. It might not match the high trading volumes of some other ETFs, but it offers enough liquidity for most retail investors. This means investors can easily buy and sell shares of QQQM without significantly impacting its price. But why exactly is QQQM a contender in the growth ETFs arena? Well, it's simple. QQQM provides a cost-effective way to access a broad growth-oriented index. Its portfolio leans heavily towards the tech sector, which has been a key driver of growth in recent years. It's proven its ability to replicate the performance of the NASDAQ 100 index, which is a testament to its quality. And lastly, it offers a reasonable level of liquidity, which is a crucial aspect for any ETF. In conclusion, QQQM is a robust growth ETF that offers a compelling blend of cost-effectiveness, tech exposure, and a solid track record. Its unique traits and strong performance make it a worthy contender in the ETF world. But as with any investment, it's essential to do your own research and consider your financial goals and risk tolerance before investing in QQQM or any other ETF. QQQM certainly holds its ground in the competitive world of growth ETFs. Having explored VGT, SCHG, and QQQM individually, it's time to draw some comparisons. After all, understanding the differences and similarities between these three growth ETFs can help us make informed decisions about where to put our money. Let's start with performance. VGT, the Vanguard Information Technology ETF, has shown consistently strong returns, particularly over the last decade, thanks to its focus on the tech sector. SCHG, the Schwab U.S. Large Cap Growth ETF, has also provided solid returns, though not quite as spectacular as VGT. However, SCHG's broader focus on large cap growth stocks gives it a more diversified portfolio. QQQM, the mini version of the popular Invesco QQQ ETF, has a track record that's shorter than the other two, but its performance has been impressive nonetheless, closely mirroring that of its older sibling. Now let's talk about risk. All three of these ETFs are growth-oriented, which means they tend to be more volatile than their value-oriented counterparts. But they differ in their approach to managing that risk. VGT's portfolio, heavily weighted toward the tech sector, is more susceptible to fluctuations in that industry. SCHG, with its broader focus, provides a bit more diversification, which can help smooth out some of the bumps. QUM, on the other hand, tracks the NASDAQ 100 index, meaning its risk profile is tied to the performance of these top companies. Moving on to expense ratios, VGT stands out with a remarkably low ratio, making it a cost-effective choice for those interested in tech. SCHG's expense ratio is also quite competitive, especially considering its large-cap focus. QQQM, while not the cheapest of the three, still offers a reasonable expense ratio for an ETF that provides exposure to some of the most dynamic companies in the world. To wrap up, let's recap some of the key points from our discussion. VGT offers strong performance and a low expense ratio, but comes with a higher sector-specific risk. SCHG provides solid returns and a more diversified portfolio at a competitive cost. QQQM, despite being the newcomer, has shown impressive performance and provides exposure to the NASDAQ 100, albeit with a slightly higher expense ratio. So which of these growth ETFs is the right choice for you? Well, that depends on your individual investment goals and risk tolerance. If you're all about the tech sector, VGT might be your best bet. If you prefer a broader focus, SCHG could be a better fit. And if you're looking to tap into the dynamism of the NASDAQ 100, QQQM could be just the ticket. As we've seen, each of these growth ETFs brings something unique to the table. The key is to choose the one that aligns best with your investment strategy. And remember, investing always involves risks, so it's crucial to do your own research and consider seeking advice from a financial professional. We've come a long way in our exploration of growth ETFs, VGT, SCHG, QQQM. We've delved into the intricacies of each, understanding their unique characteristics and potential benefits. From VGT's tech-heavy portfolio, SCHG's wide-ranging growth focus, to QQQM's ability to capture the performance of the NASDAQ 100 index, we've seen how these ETFs can play a crucial role in an investment strategy. But remember, as with all investments, it's essential to do your own research and due diligence. Market dynamics change, and what works today might not work tomorrow. Always be informed, stay updated. Be proactive in understanding the risks involved and how they align with your financial goals. And that's a wrap on our journey through growth ETFs. If you found this enlightening and want to continue learning with us, don't forget to subscribe, like, and share this video with others who might find it useful. Until next time, keep growing.